So in this session, we're going to cover receivables, and we'll start off with segregation of duties first, and then we'll talk about sensitive access a little bit after. I've got a couple of rules here for receivables. The first one, Jeff, is create customer and enter accounts receivables invoice. Again, might sound obvious, but getting a good explanation is always helpful to understand some of the underlying risks. So create customer and enter accounts receivables invoice. Why should we be looking at that one?
So first of all, you always have to understand in the context of an organization, RevRec is a very complex topic for most organizations. Sometimes they're in the core ERP system, sometimes they're in operational systems. So your AR input, the ability to input invoices in AR and create a customer, in theory, would give you the ability to, one fraud risk would be setting up a dummy customer, fictitious customer, and then entering a negative transaction, which would create a credit memo. That credit memo would set on a customer's account, and then somebody could pretend to be the customer and say, hey, I have a credit balance on my account. Can you refund that balance to me? So that would be one way of taking an asset out. Yeah. The flip side would be creating an invoice for a fictitious customer that would inflate revenue perhaps during a given period. Okay. So yeah, one other thing to think about is the context of order entry and order management and whether they're using that. And then AR just is really a repository of invoicing for lots of organizations. Yeah. Sometimes there's the intention of creating manual invoices, and sometimes there's not. But if you have the ability to enter an invoice, then you have to think about both positive and negative transactions. Yeah, yeah, and things like fake customers, that kind of thing. Absolutely. One side, yeah. And then, so then moving through the flow, from entering an invoice. So the next kind of combination would be entering that invoice and entering customer receipts. Why would we be looking at areas where users can enter a AR invoice and enter customer receipts? So depending upon the nature of the company, the organization, what those transactions in AR really represent. So if is it ordering activities that where somebody's shipping something, for example. So if like there's an order, that order gets fulfilled, that gets transferred to AR, that creates an invoice, and then a receipt against it. You could have a receipt that would offset an open balance. So if the balance being open would be something normally somebody would follow up on from a collections perspective. Yeah. So often that ability to enter an invoice and entering receipts is separate because you have the controls that you want to put in and around the invoice generation itself, the setup of an invoice, and the controls in and around entering cash receipts. So if you created a transaction that turned it into an order or comes in from another third party, like our operational system created an invoice, and if that was a fictitious transaction, like for example, you have something that ships product, then creating an order which would generate an invoice, somebody would have physical custody of the product, and therefore one of the ways to obfuscate the fraud in that scenario would be entering a receipt against that invoice, so nobody would be calling on a customer to follow up and identify that transaction was really fictitious. Yeah. Yeah. Okay. And so on this side of things, what would you consider to be some of the key standalone sensitive access risks that we should be looking for? So you can really look at transactions, like I said, entering transactions in and of themselves as both debit memos or debits, credits, if you will. So invoices and credit memos as its own standalone sensitive access risk. Is if you're not trying to create fraud, but you're just trying to, in my scenario where you set up a customer, enter a credit memo, and then ask for a refund, that would be a fraudulent scenario. But having the ability to create invoices in and of themselves could either inflate revenue or deflate revenue. And revenue recognition, that piece of the controls, if you will, in an environment is some of the greatest area of scrutiny and risk from an external audit perspective. Yeah. So those could go either ways. It could be a smoothing scheme where they're adding revenue to one quarter, then removing it from revenue the next quarter to try to make bonuses or try to hit projections for that quarter. Enter cash receipts is actually a good one as well. So there are, entering cash receipts against an existing account. So like if employees were purchasing something, as an employee benefit for a company that has product purchasing, it goes in receivables, comes out of their paycheck, for example, if they've got a balance or they're supposed to pay it, that would be one scenario. There's usually pretty good controls in and around entering cash receipts or fictitious cash receipts, because those go into a bank reconciliation. Yep. So there's a tie between what's entered receipts and what's being recorded against the bank. So there's usually pretty strong controls. Doesn't necessarily mean a receipt for one customer couldn't be entered on another customer's account. And so one of the control ultimately comes down to for that is customers are looking at statements and making sure the cash is applied to their account accordingly. So both good examples. You talked about in the context of SOD, that you can look at specific sensitive access risk in those areas as well.
Yeah, good. Okay.